The stock market is in turmoil. The dock worker strike, geopolitical tensions rising in the Middle East. We still have that looming issue of Taiwan and China. And on top of that, the uncertainty of the elections. However, we're going to listen to what Tom Lee has to say. So don't smash the like button. Don't comment just yet. And don't look for Discord links to join the coaching or anything yet. First, let's just sit back, listen what Tom Lee has to say about this situation because it's very important. And there's a lot to cover in this video. And I'm going to break it down for you. Let's listen to Tom Lee.
At Fundstrat Global Advisors, as well as a CNBC contributor, people forget, I think, but your outlook and views are always nuanced to some extent, Tom. So last time you were on, after being pretty bullish on small caps through the end of the year, I wouldn't say you didn't change that long-term view, but you did express some near-term caution. And these people want to know, the people that follow you, the people that watch Squawk Box, they want to know exactly what to do every minute of every day. So it looked to them like you had waffled on your long-term view. And you're going to say the same thing today. I think near-term, you acknowledge that there could be some bumpiness, choppiness, but by the end of the year, you think 6,000 on the S&P.
That's right. I think we're still in the midst of a very tricky period because we've got the election in less than 35 days, and now we've got two things that investors don't know how to discount. One is, mounting tensions in the Middle East, and then a port strike that is potentially going to cripple the economy. And so I think that as investors worry about this, if we get a dip, and a big dip, I think you still want to buy that dip because the setup into year end has a lot of tailwinds.
The worst case scenario for the port situation is something that we've seen. And we shut down an economy already, and that was probably a time to buy. We know that. So we've seen that movie before. Could it be? I can't imagine it could be as bad as the pandemic, but we have shut down an economy before.
Yeah, that's right. So I think it creates headline risk because, the longer this strike lasts, there'll be companies that miss. And so S&P earnings might get downgraded or some stocks might miss results. But that's all just temporary. I mean, those are just short-term headwinds because it doesn't change the long-term outlook.
Very strange that I don't remember any war that lasts, where the effects, and we've been through quite a few back in the 90s and in the 2000s. It never seemed to have as negative an effect on the overall markets as we thought at the beginning of each.
That's right. In fact, if we look at the last 6 sort of global wars or tensions, you almost always buy the invasion. The exception was 2022 with the Russia-Ukraine war because we were also in the midst of a Fed tightening cycle. So that was not a buy the invasion event. But the other times you did want to buy.
Both Iraq wars.
Yep, both Iraq and.
Was the market? Where was the market before that happened? Had levels come down, or were they trading at near highs or at highs?
Yes, this is different because we are hovering near highs and we're in an extended market.
And things aren't cheap in terms of multiples.
That's right. But at the same time, we also know there is a lot of cash on the sidelines.
Right.
Because margin debt hasn't risen for 4 months. I mean, that's pretty unusual with a rising stock market. And now money market cash has actually been rising at a time when the Fed is cutting. So I do think there's firepower.
The other issue, just the longshoreman strike, if that goes on for an extended period of time, is that something, we were talking before how much that cuts off the GDP. If it's there for a week, maybe cuts 0.3 of the GDP.
Yeah.
For every week they're out. Is that something that the Fed comes in with much more aggressive cuts and that fixes things, or are there inflationary factors that also come into play and that ties their hands?
The Fed has to kind of put that in their calculus because the labor market has also softened. So if this is a shock in a way that causes the labor market to weaken, the Fed's going to be a lot more dovish. But we get the payrolls report Friday, and I'd say maybe it sort of early hints seem like it's actually going to be a better than expected report.
But then you also add in what would happen from inflationary pressures, not only from the longshoreman strike, but potentially from oil prices going up in the Middle East, too.
Yeah, that's right. I think the Fed at this point would be more concerned if the consumer expectations got unanchored on inflation, and those have actually been improving. So I think the Fed can be less worried about the inflation side of it.
Did you see Tepper talking about China? Would you ever
subscribe to that theory?
Buy a lot in China?
Yeah, I'd say that not only did China launch a bazooka, but it's really working, right? Because the stock market is has really broken out. I think China is now the best performing stock market this year.
But was the move made? I mean, I think, we had Kyle Bass on yesterday, and I think he would argue long term, no matter how you want to think about China, it's a bad bet. He was suggesting maybe in the short term, it's a good bet. And I don't think he was necessarily opining on whether the bet is over. But the move, obviously, the big move has happened. The question is, do you see that doubling? Is that in the cards at this point of the game?
Yeah, I mean, something to keep in people's back of their mind. Over the last 10 years, China has underperformed the U.S. by 7,700 basis points. So if China doubles, it's still underperformed by like 5,000 basis points. So, I mean, there's a lot of room for a rally, even if it looks corrective.
I think his phrase was something like, it's just a bad bet on communists.
No, he's saying long term it's a bad bet, but he's saying short term it might be a good bet.
It's not our grandfather's communism. It's almost, I don't even know we need a portmanteau for what capitalism, based with communism is.
Yeah.
Bidenomics, maybe. Kidding, Andrew. Kidding.
Pretty interesting things that Tom Lee has just said. I'm going to break them down for you. If you guys are interested in my one-on-one coaching, my Discord, my full training course, I'll have more details for it later on in the video. But if you guys want to sign up, you guys can sign up at investorcorey.com. It's right there on the screen. The link is in the information box below. What Tom Lee is basically saying is that there's near-term caution, but he's mid to long-term bullish, and that the S&P could reach 6,000 by the end of December, which is $600. Right now, it's at like $565, $570. So there's a lot of movement still left in the S&P by the end of the year. With the geopolitical tensions, the dock worker strike, as well as the election, there's so much uncertainty in the market, which makes it pretty much difficult or impossible to gauge price direction at this point. We got long-term tailwinds, short-term headwinds based on this analysis. So what Tom Lee says was correct. You typically buy the invasion. All the wars over the past 30, 40 years or 50 years, you pretty much buy when those events happen because the stock market recovers and goes higher. In fact, the only time in the past 50 years where you really shouldn't have bought under the war or the issue of war was with the Ukraine war. Ukraine and Russia in 2022, that was different because the economy was already hammered with a pandemic at the same time. But typically when you go back and you look at history, every time people feared the market was going to be down, it was never as bad as anyone thought after the war had started. September 11th, the war in Iraq in 2003 and 2004, and the list goes on. Every time there was a war or geopolitical tensions, it just never was as bad as we presumed it to be, and they turned out to be by the war. So when we look back, these wars or geopolitical tensions never had the effect on the market in a negative way that we thought they would, and they turned out to be by the invasion events, so to speak. The issue is every week that the dock workers are on strike is something like 1/10 of the GDP, which is not good. So we really have to resolve this. This needs to be resolved. It could really cripple the United States if the dock worker strike continues on and on and on and or gets worse. And if the labor market gets weaker, then the feds are going to become more dovish and we would see more rate cuts. Now, jobs added and available workforce has increased and it's growing at a rapid rate, and recession is not likely as inflation is dropping like a rock. That's what Tom Lee said. When you think about that, jobs added is up, available workforce is up, unemployment is down, inflation is down. The feds aren't really concerned with inflation due to the dock workers strike or the geopolitical issues because of the fact that consumer confidence and consumer expectations has been improving month over month, quarter over quarter, and year over year. So this is really what the feds are looking at. So right now, it's not a concern to them. Another thing that Tom Lee touched base on is Chinese stocks. You guys want to jump into these stocks, Alibaba. You guys want to jump into NIO and Li Automotive, BYD. There's others as well. But you have to be very careful. It is a very big buying opportunity, but there could be more of a pullback on the way, short to midterm. However, long term, going out 1, 2, 3, or 4 years, I think personally the Chinese stock market is great to invest into because they've underperformed the U.S. stock market by 7,700 basis points. And even though they're up right now, if they were to double from where they are now, they would still be pretty close to 5,000 basis points behind. There's a lot of growth potential there, but it's really all going to depend on Taiwan and China. If no issues arise there and things possibly even improve, and the Ukraine and Russia conflict improves or goes away, and once we get past the election time with those three things happening, if the dock workers situation also ends, then I could see the Chinese stocks running. And like Tom Lee said, this is not really a big issue long term. This is like a bump in the road. Even if the dock workers were to strike for 4 months, in a year or two down the road, it's almost going to be irrelevant at that point. This would have a short to midterm effect. If they stayed on strike till December and resolved it, we might be February, March, or April before we catch up and things smooth over. Maybe a little longer, maybe a little less. But what's going on with the dock workers strike right now is not going to have long-term effects that last 3 or 4 years. And that's what Tom Lee also had explained in the video. The weird anomaly we have in the market right now is the Feds have cut rates, but the money in money markets has gone up. And not only that, the margin hasn't increased, or margin debt. So with margin debt not increasing, money markets, money accounts going up, and the Fed's still cutting rates, it signifies, in my opinion, that there's going to be a pretty big move into the stock market. And with this strike that's currently going on with the dock workers, they're just looking for an excuse to dip the market so they can bring that $1 trillion over and get it into the stock market and buy the dip, which is what I think is really going to happen. If the dock worker strike doesn't have the stock market to dip as low as they want, even with the election news and geopolitical tensions, if these things don't cause the market to dip that drastically, then they'll start to buy in and it's going to run. Or it will pull back like they want and it runs. But either way, it's a buying opportunity. Pretty much between now and election time is buy the dip, buy the opportunity, dollar cost average. And if Tom Lee's correct and the S&P goes to 600 by the New Year's and the dock worker strike resolves before then realistically, middle of November to January is going to be a bull run, is going to be great. So you want to really do your due diligence and understand these factors in the market because they're very important. Really, small cap stocks are getting fried from the pandemic. They're the stocks you want to invest into. You want to invest in finance, small cap, some retail, and industrial. So realistically, SoFi, Bank of America, Wayfair, Walmart, NEO, Alibaba, BYD, Li Auto, all great stocks. If you balance your portfolio out with these stocks as well as Palantir, then you really have yourselves a really nice portfolio. Add some SoundHound in there while you're at it. This is good. And so I'll tell you guys that this is the list that I would seriously be looking at. These are really the only stocks, in my opinion, right now that are super strong. Starbucks and Nike are great buying opportunities after the election. But right now, going into the election, you really want to be looking at PayPal, Block, Wayfair, Walmart, SoFi, NEO, Palantir, Kraft, Coke, Alibaba, maybe some Amazon, but I would hold off on Amazon for now, just because I believe Wayfair and Walmart will do better, and so will Alibaba. In fact, Alibaba's already done a lot better. You could add some Li Auto and BYD as well if you wanted, but I prefer NEO because of the growth potential. I mean, if NEO goes to $13, it's doubled in value, doubled in its stock price. Whereas if you buy BYD, it would have to go to over $300 or $400 for you to make the same return. I don't see that happening, not for a while. So if you're in it for the profit, which you should be, because that's what investing is, you really would want to be investing in NEO over Li Auto or BYD. Look, the Feds are already dovish. They've cut 50 basis points. We got another 50 basis points coming by the end of the year. When you compile those 50 basis points, again, with the previous one, that's 100 basis points this year, and we're going to have 50 to 100 next year. We have PMI data that's coming out today on services, which should be up because it's been consistently going up, although manufacturing has went down slightly year over year, but quarter over quarter, fairly steady, as well as the services that's coming out has been pretty steady, but it's been getting better and expanding. There's been expansion in services, which is to be expected considering the circumstances. We also have payroll data coming out tomorrow, Friday. So we have to look at Friday, October 4th's payroll. If the services data today is good and payroll data is good tomorrow, we have some more bull runs in us, maybe some slight ones for the month of October, but there's going to be a pullback near the end of October going into the beginning of November for the elections. And that's what I would say. So if there's some good PMI data this week, then run some wheel strategies, sell some puts, make some good profits. But if you ultimately don't want to mess around with that, you can invest in the stocks I told you earlier in this video, and you can just buy the dip, dollar cost average, and hold long. And once the election hits, then we can start looking to sell puts and get into better stocks. If you guys are looking to improve your financial health and your financial freedom, I would love to help you. I offer full training, Discord, and one-on-one coaching. It's a very serious mentorship. So if you take your financial health seriously, then I would love to help you guys. You can use the link in the information box below and investwithcorey.com. And I would love to help you guys grow your portfolio in a safe and very easy way. This way you can live your life till its fullest and you don't have to be stuck in front of your computer all the time. But you have to show up committed, ready to learn, and I'll show up committed, ready to teach you guys. I have students in the Discord that have taken $8,000 portfolios to $18,000 in 2 months. All of my students are up 10 to 15% every single month, and they grow very rapidly. That's what I want to do. I want to show you guys how you can do the exact same thing. If you guys are interested, I would love to help you, and I will see you when you are ready to commit. That's going to do it for today's video. Thanks so much for being here, guys. We'll catch you on the next one.